tax avoidance has been a hot issue during the financial crisis as governments struggle with their budgets. The European Parliament created a special committee this year to propose new ways to make companies pay their fair share and to create a more level playing field across the EU. At a committee hearing, European Commission President Jean-Claude Juncker discussed the proposals. An EPP member, Juncker had come under fire for the granting of tax breaks to large companies while he was Luxembourg's Prime Minister.
Profits must be taxed where the profits are generated. And the second guiding principle consists of not losing the vision when tax policies must support our employment and investment policies in Europe. And the simplification of the systems, the reduction of the cost of complying, and putting in place a legal system are essential, if not preconditions, to allow the European economy to take off.
The so-called LuxLeaks tax breaks were only one example of an EU-wide practice the Special Committee aims to stop. One proposed solution: establish minimum standards under a common consolidated corporate tax base, the CCCTB for short. The EPP group's Burkhard Balz is a member of the Special Committee on Tax Rulings.
For us, it is important that we get harmonization. It must be very clear what to tax and where to tax. That is why we must see that there be fair competition. Competition in itself is not bad, but we must be sure that in the future the unfair part of it no longer exists.
One risk the committee wants to avoid is putting European companies at a competitive disadvantage compared to large multinationals which operate across Europe. That's why the EPP group supports country-by-country reporting, but only for large multinationals.
The EPP is in favor of such a country-by-country reporting for large multinational enterprises. That way, the tax tricks can be recognized more easily. Where large enterprises generate their profits, how much tax they pay in the countries, and how many employees they have.
One way corporations avoid taxes is transfer pricing. The price a subsidiary in one country pays to another elsewhere. That way, a company can shift its profits to lower tax countries. Alain Lamassoure is chairman of the Special Committee and a member of the EPP group. He calls for pressure on leaders who have stalled on anti-tax avoidance measures proposed since 2011.
Today, thanks to the media, public opinion is mobilized because it is easy for a taxpayer to understand that he pays a lot of taxes and that some of the richest companies in the world manage not to pay any taxes. That is totally unacceptable.
The report notes that more than 70% of profit shifting occurs through transfer pricing and location of intellectual property. The committee's proposed EU-wide solutions can help stamp out that practice. The Special Committee concludes its report with some strong language. It calls on EU leaders to make clear political commitments to taking urgent action to tackle this situation, which it says can no longer be tolerated.